Welcome, everyone, to the Win Now podcast, hosted by Deborah Byrd, founder and CEO of Plug and Play SM.
I am so excited for today's show, so let's go.
And then myself, Todd Bookspan, founder of Win by Noon. Welcome, everybody, to another edition of the Win Now podcast. I am Todd Bookspan, the founder of Win by Noon. We're super excited you're here. And as always, I'm joined by my co-host, CEO of Plug and Play SM, Deborah Byrd. What's going on?
Happy Monday and happy May 1st. Start of a new month. Love it.
It is crazy that this year is already 1/3 over.
It is. I didn't look at it that way, but you're correct. And it's starting to get hot in Texas. We've had some crazy weather where it was kind of cooler. I know you guys are in great parts of the country too, where it's good weather, but I think we're going to hit 80 today. So that's good.
Oh, we're hitting 100 today in Arizona, and looking forward to heading over towards our guests. So we've got the lead analyst for HousingWire. So I know, Deborah, like, you're super nerded out, and I get the gift. But real quick, before I bring Logan on and introduce him, tell everyone why you're so excited that he's here.
Well, so I consume a lot of content, and I'm always careful on just context, because sometimes data can be misleading depending on how it's presented. And one thing that I've loved about Logan, and I've really been following him for a while, and ironically, I follow him more on Twitter, which I really only get on Twitter to look up what Logan's talking about and kind of see what's been retweeted. But he is your go-to interest rate, mortgage market data nerd, but able to present it in a way that's easy to understand and just equip you to be more of an expert when you're out there talking about, your lens on the data. And so he's actually the one that I saw him and Mike Simonson, which now they're a duo. So I know a lot of people on here also follow Mike Simonson, who is the owner of Altos Research. But the fact that you two are together, so you have a housing nerd and a mortgage, nerd all together, is just a dream come true. So I'm a fan of Logan. I've been, again, a fan for a while, and I first noticed the hair. So maybe we'll get a hair demo from him. He's got some great hair, but he's all over the place. When you turn on any media news channel, he's your expert and go-to guy. So,
well, without further ado, Logan Mohtashami. See, I want to make sure I got that right. Was I close, Logan?
No, that was pretty good. So,
Mohtashami, is that?
One time I was on Bloomberg and they totally messed it up, and the anchor said Hohtashami.
What?
And I was like, but I just, you're trained not to just stop and stare, but you just kind of snicker a little bit. So that was good enough for the last day.
Well, I'm glad. I always want to be great, because I always want to be super respectful, and just like Deborah, a big fan and super glad you're here. So Deborah, I'm gonna let you ask the first question. Where do you want to get started?
Well, so I know the burning question, for a lot of people listening, is, where are interest rates headed? Is it true that they could possibly be in the 5s by July? I've heard other economists say that, around May 10th, we may see a little bit of a break, but give us your insight of what things you look at to help you come up with that opinion, because sometimes you turn on the channel and everyone says something different, and they have a different way of proving to you of why they think that. So you're the expert. So what would you say? So
what I do every year is I take my yearly forecasts very seriously. And in regards to mortgage rates, I actually never target mortgage rates or mortgage-backed securities or certain data lines. I only target the 10-year yield. And every single year, I try to give people a range on where I believe the 10-year yield will be, so people have an idea of where mortgage rates can go. Now, I started incorporating this in 2015. Everything was working excellent until March of 2022. And, when the Fed pivoted, the Russian invasion, everything, the 10-year yield and mortgage rates accelerated higher than what we normally would see. But this year, the 2023 forecast was the 10-year yield would be in a range between 3.21% and 4.25%. So if we take mortgage rates and assume the spreads are very bad, that's between 5.75% and 7.25%. So far this year, it's been between 5.99% and 7.10%. So we've stayed in that range. But for me, to have the 10-year yield break under 3.21%, I would need to see the labor market start to break. So for that entire forecast, it was based on jobless claims need to break over 323,000 on the 4-week moving average. Jobless claims is basically unemployment benefits that people apply for. That data line comes out every Thursday morning, 5:30 a.m. Pacific. To me, that's the very key data line at this stage of the expansion. So far, the labor market, even though it's getting softer, has not broken. So far, the 10-year yield, with all the drama that we've had this year, even with the banking crisis, I kind of have a little joke a few months ago. I said this, there's a certain level in the 10-year yield. I'm going to call it the Gandalf line in the sand. You shall not pass it. We've kept on bouncing off of these levels 6, 7, 8 times. So the bond market and mortgage rates, for me personally, looks about right to where the economic data is. And that's kind of how I track mortgage rates in the bond market on where I think the economic data would be going. And so far this year, it's looked about normal. I don't believe we should get above 4.25 on the 10-year yield last year. The dollar was getting strong. We had market stress. Bond yields were rising. We've peaked back then. So as of now, it looks good. But to me, it's not so much about the growth rate of inflation falling as the labor market breaking. And once that does, the 10-year yield should break below 3.21%. Look, maybe 2.72% would be the next target. There's your case for, 5% mortgage rates this year. But until that happens, I think the range has stuck, and it looks normal to me with all the economic data we're dealing with.
So do you think they're going to be possibly as low as in the 5s in July, or do you think that's
it's really the labor
pushing,
market,
huh, Logan?
Yeah, it's really the labor market. And for me,
okay?
Early on in the COVID-19 recovery, I talked about how job openings will get to 10 million in this expansion. So labor market breaking is not going to be as easy as people think, but continuing claims, that means people who are filing for unemployment benefits over 10 days, that's rising. The job openings data is falling down. Wage growth is slowing down. Those are all things that are good for mortgage rates. And for later on in the year, if the economy gets weaker, we should be able to break that. The spreads have gotten worse since the banking crisis has started. So that's going to be the X wild card of this year. Do the spreads get any better while the credit market is getting tighter and tighter? I think that's the one question, because really mortgage rates should be lower than what they are today, but they should be in the 5% if we had normal spreads. But the market is very stressed, and I think the Federal Reserve likes that because their whole housing reset. The last thing the Federal Reserve wants is housing to kick back up into gear, because to me they're targeting a job loss recession. That's the way they want to fight inflation, like they did in the 1970s. So there's a lot of unique dynamics that are going on now that we haven't had to deal with in a very long time.
Yeah, I think it's so interesting to watch the fact that there are all these different dynamics. It's just not cut and dry, right? I mean, everyone wants, expert like you to have the crystal ball, and it's just the kind of the hurry up and wait. And it seems like the employment thing is inevitable, right? We keep. Are
you talking about Deborah?
Well, I try not to make eye contact when I'm on Zoom with anybody else, but maybe.
Wink, wink.
Yeah. So, everyone has to have their own version of what they think drives mortgage rates. I'm a 10-year yield guy. I've always been that way. So for me, it's what do I think pushes yields higher, pushes yields lower. But regards to mortgage rates, the spreads getting worse after the banking crisis is a big deal, because really we should be at 5.5, 5.25 today if we had normal spreads. But I always have this thing, for everybody, if you really want to nerd out, go look at a chart of the 10-year yield and mortgage rates since 1971 all the way to 2023. They have been doing a slow dance because they have been in a really good relationship, slow dancing all the time, late 70s, early 80s, all the way now. So they tend to trend together always. Sometimes the spreads are bad, like we see now. So, the dance partner backs up a little bit, and sometimes they get closer. But those two have been in a very healthy romantic relationship since 1971. And that's why I try to get people to focus on the 10-year yield and what drives it: growth, inflation, recessionary data. These things to me matter for the 10-year yield, and they typically trend with mortgage rates.
So for someone who doesn't understand, then why now are they dancing apart a little bit? Why is that spread wider?
After the Federal Reserve has gotten out of the mortgage-backed purchasing market, so mortgage-backed securities market, the spreads have gotten wider. The risk in this sector of the economy has risen a lot. So the Fed, if they wanted to, can change this anytime they want. They purposely have targeted the housing market as their sacrificial lamb early on. And this is why they're not even talking about hoping the spreads get better or anything in that nature. During the previous expansion, they were buying a lot of mortgage-backed securities. It didn't, move rates in itself. The 10-year yield and mortgage rates still trended the same, but there was more stability in the mortgage market. That's gone right now. So that stability is gone. And on top of everything else, everyone's talking about recession. They're talking about bank credits. So the financial markets are stressed in that regard. So in that case, the mortgage-backed security market, which traditionally gets stressed during a recession or heading into a recession, has now been stressed during an expansion. So this is kind of a whole brand new game for everyone. And that's part of that is the Federal Reserve did not want the housing market to perform well. They wanted a housing reset. They got the biggest one-year sales crash in history. And they're kind of leaving this alone because in their minds, the worst thing ever is 1970s inflation, even though we don't have that here. So they're not talking about trying to help the housing market. What I do believe what will happen is if we ever do get a job loss recession, the Federal Reserve doesn't really want to cut rates fast. They're going to hope that the 10-year yield falls, mortgage-backed security market gets better, and that will help stimulate the economy with the housing market being first into a recession during this expansion, hopefully leading the economy out of recession when they want to facilitate better economic data. But as of now, their full intention is to create a job loss recession because they believe if you're running 1970s economic models, you need at least 2 to 3 million people to lose their jobs to defeat inflation. So that's why it seems weird for the Fed to keep on hiking with all these recessionary indicators, but that's their intention. That's why they said they need pain. And so far, the labor market, we haven't lost enough jobs for them to feel comfortable that inflation is falling down on its own. So there's a lot of new dynamics that I think if people haven't tracked economic data for a few cycles, it's going to seem really strange what the Federal Reserve is doing right now.
So you actually feel like they know what they're doing because a lot of economists believe they think that they're just dumb and, dumb as the day is long.
My thing is that I understand what the Federal Reserve thought they needed to do, but if we had 1970s inflation, the 10-year yield would be so much higher than what it is right now. And one of the things in my articles when I write about the 1970s inflation, rent inflation took off twice, like in 75 and in the late 70s and early 80s. We can't have that kind of market. And the reason why rent inflation is so important, that's the biggest driver of core CPI. So you need housing to boom again. And the growth rate of rent inflation is already cooling down. We know that. It just lags on the CPI data. I remember going on CNBC in September of 2022 saying, okay, CPI is still going to be hot. But remember, this has been driving by kind of a late lagging indicator in shelter. By this time in 2023, all of us are going to realize the growth rate of rents are falling in the other data lines that we track, more recent, and that's occurring. So it's really hard for me to be putting in the 1970s inflation, but they are old. Federal Reserve members are not young, and they are slow. That's my thing. For my podcast, I always say the Fed is old and slow, so you go with that. So they're going to be late to the ball games. I mean, remember they talked about the banking situation is great. There's no problem at Sound, one bank under, two bank under. They're in my belief that they don't mind credit getting tighter to create a recession because they are so bent on at least 2 to 3 million people losing their jobs. Then they can feel better because in their minds, they think wage inflation creates, inflation that's a lot. Some of it's even just driven by supply. Wage growth has already been slowing year over year, has been slowing down since the early part of 2022. And we've had a tight labor market. So the 1970s narrative is already lost just by that. So it's just, we have to deal with this Federal Reserve. They're bent on it. They want to get at least one or two more rate hikes in and just take it for where it's at. I'm not a Fed pivot person. I believe the Fed will only pivot, and pivot to me means the language will change about the economy when jobless claims break over 323,000. This is a model I wrote for last year going into this year. And until that happens, don't look at the Fed as trying to keep the expansion going. They want one thing: higher unemployment rates. They've been forecasting it for over a year. They've been forecasting a recession. Their Fed minutes recently even talked about they're going to have a recession. So because jobs are not being lost fast enough, they're kind of mad. So they're hoping that credit getting tighter actually helps them out get to their model where we see 4.5 to 4.75 unemployment rates, and that will kill the wage growth because wages growing in this country too fast. You can't have it. The Federal Reserve is like, no, we got to stop this. Lower wage workers getting paid more. No. So their job is to kill it, and they're doing their best to get there.
Okay, so that actually just makes me think of a question that came up today. I was teaching a social media class for real estate agents, and they were talking about this very topic and were really concerned of the possibility of people losing jobs. Is this going to create this boom of foreclosures or bankruptcy? So I'm sure you have an opinion around that, especially with
yes.
what may be infused in the media. So what color would you like to add around that?
So this is my specialty: credit channel risks, inventory channel risks. I've been doing this for a very long time. And the people that are talking about 2008 credit risks do not have a single minute of credit risk training. You can see this. And what I always talk about when I go to conferences and I speak, I've got all these charts. And what I tell people is that after 2010, we had a rule, qualified mortgage. Okay, so that fixed the debt structures of residential lending. We had the best loan profiles ever recorded in history. I used to be in LO for 17 years. My father is still in the business. Our family's been in banking since the late 1950s. This is our thing, our kingdom of heaven. We know this stuff. And homeowners in America have never looked better. Why? Because most of them are 30-year fixes, fixed debt cost, rising wages. Right? Your wages keep on growing. Your total housing costs get low. We had 3 refinancing waves: 2012, 2016, 2020, and 2021. So people's housing costs versus their total wages, where they are, what age they are, because people are living in their homes longer and longer, has never looked better. Back in 2002 to 2005, we had a massive credit boom. So much short-term debt, ARM products, interest-only loans, 80-20s, 80-10-10s. None of those loans exist. So what happened back then is 2005, 6, 7, and 2008. All before the job loss recession happened, people were filing for foreclosures, bankruptcies, rising toward 2008. Then on top of that, the foreclosure crisis got a little bit worse because jobs were being lost. None of that has ever been happening for the last 12 years. The 2005 bankruptcy reform laws fixed the consumer credit side. So one of the reasons we just had the longest economic and job expansion ever in history is that consumer credit channels are different now. So homeowners on paper have never looked better. On top of it, 42% of homes in America don't even have a mortgage. So we just have such a unique profile. What will occur whenever a job loss recession happens? Number one, the people that have the highest unemployment rates typically do not finish high school. Those are service workers, renter financial profiles. Okay. They could be part of a homeowner profile if they're a dual household income. People that are homeowners tend to be mostly employed. So during COVID, when I wrote this recovery model, April 7th, 2020 for HousingWire. HousingWire wasn't even going to publish that at first because they thought that was crazy, but they did. And I said,
I was going to say, how many of your stuff hasn't been published before?
No, everything's published, but that one, you got to remember, back in it, we were hoarding toilet paper and everybody was talking about a depression. So I'm talking about, we're going to recover this year. And everybody's like, no way. And one of the biggest mistakes I saw back then, even for my economist friends, they saw 20 to 30 million people unemployed. And they said, there's no way housing could come back. Housing's going to crash. I said, okay. What about the 133 million people working? We're like, what? Yeah. What about them? My army is bigger than yours. Okay. So when the next recession does happen, I already have 155 million people working for me. If mortgage rates go lower, housing is disproportionately affected, negative or positive. Higher rates when the economy gets better, negative for housing. We had a great labor market, right? That labor market back then, last year was good. We created 4 million jobs. But what occurred was mortgage rates got much higher than we usually accustomed to. Home sales fell. But in a recession, if we follow the 1982 post-recession models, mortgage rates fall. So I've got 155 million people working. If the Fed's target is 2 to 3 million, right? That means you got 152 million. If the majority of that are renters, disproportionately housing is going to benefit because the majority of people are working. We saw what happened to the housing market when mortgage rates went from 7.37 to 5.99%. So I do this tracker. What I do every single week is I run this economic model tracker to give people a heads up. Back in November 9th, the housing market changed. Nobody cared, right? Every single week, the data lines got better. Why? Because it's sexier to talk about housing crash, home sales falling, big collapse, housing bubble, all that stuff. During that period of time, every single week, the housing data got better. So now we're like, oh my God, demand is stabilized. Pricing is firm. What happened? You believe in people who believe in economic models. They're not exciting. Trust me, I get it. It's just nerdy stuff. I try to make it as entertaining as possible. But all the media outlets, all the economists that were talking about big price declines, so far the month-to-month stuff has been positive. Why? Because demand stabilized and total inventory levels are all-time lows. Traditionally, going back to 1900, you don't have major nominal home price crashes with inventory levels low and stable demand. It does not exist. We do not even have data to even correspond this. So what I saw happening is what I've seen now the fourth time in the last 10 years. Forward-looking housing data got better. Purchase applications, they look out 30 to 90 days. We've had, since November 9th, if I make some adjustments to holidays, 16 positive prints, 6 negative prints. Demand stabilized, housing sales picked up. There we go. Nothing too complicated at that. That takes away the big bubble crash or, home prices, people 25, 30%, people talk about home prices falling this year. Not happening, right? So you keep things simple, supply and demand economics. Total active listings are still low. They're not rising in a fast pace this year. New listings data, that's what we do here at HousingWire. We break down the new listings data, active listings, but we have it weekly. Like we have the fresh weekly data. I get it every Friday night and Saturday morning. It's not fair. And then my job is to show you guys the tracker so you can see it. New listings data trending at all-time lows this year. I'm going to repeat that. New listings data trending at all-time lows. It started to trend at all-time lows to the second half of 2022. Even 2022 and 2021 data were trending at all-time lows. If you're talking about massive supply spikes, you're going to need to see total active listings and total new listings data start to spike itself. It never happened. It actually hasn't happened for like 12, 13 years. So when we look at the NAR data, a lot of one of the charts I like to show people is I take the NAR data going back to 1982 to 2023. Normal active listings per the NAR is between 2 to 2.5 million. What we saw in the year 2000 is sales were booming. There's a massive credit boom. Inventory went from 2 million to 2.5 million in the year 2005. Then in 2006 and 7, inventory spiked up vertical. It was the first time in history in 4 decades that people were selling their homes, but they couldn't buy. Right. And that's housing economics. That's the simple form of housing economics we forget. Nobody talks about it this way, but a traditional seller is a traditional buyer 75 to 82% of the time. That explains why inventory data has been stable for decades, except 2006 to 2011. Why? Foreclosures and bankruptcies. These are forced credit sellers that cannot buy a house. In theory, they're homeless, renting, or going to live with a family member. 30-day delinquencies near all-time lows, 60-day delinquencies near all-time lows, 90-day delinquencies near all-time lows, new listings data, 2023, trending at all-time lows. This was the backdrop for the big housing price crash that so many people were pushing. And what have we seen? The data stabilized right in front of everyone's eyes. So I always have two things I always say. Economics done right should be very boring. This is not a sector that's very sexy or hot and flashy. If you do it right, it's terribly boring. And you always want to be the detective, not the troll. So my job is to connect all the data lines, all the economic models, data lines, and to try to explain what's happening. And what happened last year is toward the end of the year, housing data started to get better. Nobody cared. Why? Because focusing on forward-looking data is boring. I get it. It's not very exciting, but it worked because we're sitting here. May, inventory is not spiking up in any fashion. Normal seasonal increases in supply. Housing demand stabilized. The builders, the stocks are at 52-week highs. New home sales is starting to pick up. None of this was being talked about on why this occurred. So if you like nerdy data stuff, if you like charts, if you like all the economics work, because even though I'm known for a housing guy, my whole thing is about economic cycles. And like every single data line we have, I get to nerd out on. I can do that, but it's not going to be the most exciting thing. Like I could get the top 20 housing economists. I could put them in a YouTube. They'll get 200 people looking at them. I could get one doom porn posting housing crash person. 3 million people would look at that YouTube. Why? That works, but that's not correct. This is the correct side because if you forecast models or you talk about it, you could connect the dots. That's just entertainment, right? So I can explain to you why housing data has stabilized, but it goes back to November 9th. And that's when rates started to fall and purchase application data started to get better. And this has happened in 2013 and 14 when data lines got better. In 2015, this happened in 2018, 19 when data lines got better. This happened during COVID, with the America's Back Recovery model. We saw this forward-looking data get better. And now this is the fourth time in the last 10 years that forward-looking housing data got better. People ignored it. And now people don't know what to make of all the housing data.
I just
So
love
what about?
I'm an
Go ahead.
econ nerd. I'm an econ nerd as well. If I didn't get in the mortgage business after I got my MBA, I probably would have gone back and studied economics a little more. And so, I love the fact that you said, okay, we're looking for jobless claims, 323,000. You've got your Gandalf line on the 10-year note. Obviously, we are going to encourage all of our listeners to be listening to your podcast and following you on HousingWire. What other things can people be looking for to determine what's going on, number one? And then number two is you talk about the Fed really wants to slow housing more, but you just painted the story for how housing's not going to slow more.
This is a problem for them. I saw one of the Fed members come on TV and he said 6% mortgage rates. That's going to make our job harder. People buying homes, having sex, having kids, buying more stuff for their families, the Federal Reserve doesn't want, but you can only do so much with the Federal Reserve. They could only try to crash the economy so much. And now housing data has stabilized. Now, inflation in itself, during the housing bubble years, we didn't have inflation break out, right? Because home prices are not part of the CPI data or the core PCE. Rent inflation is. So the things that the Federal Reserve in theory are supposed to be worried about is already getting better. Now, to their credit, because a lot of us have hassled them, they've created their own little index that takes rent inflation out of the equation because they realize the data lags. So right now, the Federal Reserve is worried about service inflation, airline flights, stuff like that. They think it's too firm. When I talk about economic cycles, there's a place called the Conference Board. They're basically the people that created the IMF, the World Bank. They give their information to the White House, Wall Street, the Federal Reserve. Leading economic indicators is part of my 6 recession red flag model. I actually got to present to the Conference Board last year. It was probably my happiest moment ever. And I've told them that my 6 recession red flags are about to come up. The leading economic index is now down 10 straight months. If you go back post-World War II, whenever that happens, a recession does occur. But at this point, with all my 6 recession red flags up, I'm just looking at the labor market because the labor market dynamics are different now. Why? The baby boomers are aging out. So I always have this thing during the COVID-19 recovery. I said, we're going to get 10 million job openings in this cycle. And everyone's like, no, that's impossible. Oh yeah, we're going to get it. Why? Because no country has a Dorian Gray labor market. Everyone ages. The boomers are leaving. They've been quietly leaving the workforce. They need to be replaced. So it's kind of a wash with the labor market. There's parts of the US that don't have a lot of prime age labor force growth. So job openings should get to 10 million. Not even the job openings people would believe me, but that happened quickly. Job openings data went from 12 million to under 10 million now. The continuing claims data is rising. So the labor market is getting softer. It's just not cracking. So for me, I've kind of moved past from the Fed on how many rate hikes are left or anything. It's how they respond when jobless claims break, because in my minds, they're telling us, we don't want to cut rates. We don't want to cut rates. The market's already forecasted like 2 rate cuts at the end of the year. So there's going to be a tug of war. When does the Federal Reserve blink? Because they're known for saying one thing, and then all of a sudden, 6 weeks later, they change their mind. So I don't think that dynamics change until jobless claims break over 323,000. The reason I use that number is there's a percentage of unemployment rates and jobless claims rising. If you go back to post-World War II, that's when the labor market breaks. That's when I think the labor market will break. And in their minds, they have to say something about that. Until then, they're like, nope, we're not going to cut rates. We need more pain. So they're keeping on script to that. So leading economic indicators is very recessionary at this point. So just look at jobless claims, job openings. It's jobs week this week. So we're going to have a lot of labor data. Take that 1 week at a time. The housing tracker is here to look after everything, and it matters to the 10-year yield and mortgage rates. That's why I try to incorporate my economic models for housing economics. The demographics in America are great. That's not a problem. The biggest demographic patch in America are ages 28 to 35. So they're running right into the first-time home buyers year. So one of the things that we talk about is inventory falling for years. Why did that happen? Well, if you get more first-time home buyers or more millennials buying, they started to buy in 2013, they take that inventory off. They're not like a move up or move down buyer, which basically provides a house and then they sell. So when you get more younger people buying, that inventory gets knocked off. The 2 times in history that we've had inventory grow, 2014, mortgage rates went up, purchase application data went down, inventory grew 200,000. That was it. Last year in 2022, biggest spike in mortgage rates in history, biggest collapse in home sales. Inventory grew not that much, right? So we're nowhere near the historical norms because homeowners on paper are doing really good. I mean, the best hedge in America, not even America, on planet Earth, was a 30-year fixed mortgage in America. Why? Because other countries have short-term debt. When we think about an inflationary period, it's been decades since we've had to deal with this. What is the one thing that happens with inflation? Your wages grow up. So all these people that have 30-year fixed mortgages and they refinance and everything, their cash flow was already so good. Now, in an inflationary environment, your wages grow up faster, but that debt payment stays the same. So that's why they always say that one of the best hedges in the world is an American 30-year mortgage. Absolutely correct. Their cash flow got better. So unlike a renter that has to deal with rent inflation and everything else, the American homeowner on paper looked great before COVID. They look even better now in this sense. So people just don't say, you know what, I'm going to ruin my own financials, sell my house to go pay a higher cost for. No, it doesn't work that way. It's never worked that way. So trying to get people to understand how the credit markets are different now is that when you look at all the housing data, and I put up all the charts for them, my God, American homeowners have never looked this good. And I think that's one of the reasons why we haven't seen inventory spike up like we saw from 2005 to 2008, because back then we saw credit stress. Now, 30-day lates, 60-day lates, 90-day lates, near all-time lows, new listings data, all-time lows. Not the kind of marketplace that has inventory spiking.
Do you think any of that has to do with, and I know you were concerned about this historical low interest rates and what the potential consequence could be, even though we were all fat and happy doing a bunch of refis, helping people buy. But now I think it's 63% of the mortgaged homes have an interest rate that start with a 2 or 3, and about 80% that are 5% or lower, creating this, they call it house hostage, feeling, or people who just don't want to sell because they're like, I mean, I have a 2.5% rate. So like even me personally, I don't love our primary home, but I have a 2.5% rate. So it's like, how much would I want to sell and maybe buy something else and move up? Just the cost and interest alone is quite a bit. Do you think
Here-
that's playing a role in inventory and, people just not wanting to list? Because we've never in the history of time had so many people with such low interest rates.
Here's the one thing. I actually don't believe in the mortgage rate lockdown premise for this reason. New listings data got an all-time low in 2021 when mortgage rates were at 3%. During the previous expansion, we had mortgage rates between 3.25% and 5%. So we've had low mortgage rates. What I have seen in the credit data and inventory data is that from 1985 to 2007, people have been living in their homes for 5 to 7 years. From 2008 to 2023, depends on who you listen to, that housing tenure has doubled. People lived in their homes 11 to 13 years. All before COVID happened, this was occurring. So during this time, even when mortgage rates went from 5% in 2018 down toward 3%, the new listings data wasn't really growing as much. I just think people live in their homes longer and longer. And with everybody that has a 30-year fix, when you have to move, you move, but it's also not that easy, to move anymore. You really have to qualify. And again, when home prices rise, that bigger home that you want is also going to cost more. So you have to have the wages to be able to take on a bigger mortgage. The rate variable plays a part into that, but even in 2021, new listings data did not explode up higher. In fact, when rates fall, we don't have active listings grow. The only two times we've had active listings grow is when rates rise and demand gets hit. So this has been in the works for over 12 years. And that's why I always say that, the mortgage rate lockdown sounds great. It sounds very easy. Everyone's bought into it, but this goes back 10, 12 years. People weren't moving as much before mortgage rates got below 3%. And we had 3.25% mortgage rates twice in the previous decade. So there's a little bit more at play there. And I just think the total cost of housing is so good for people. And part of that is, people have lower mortgage rates. But whenever you refinance, you re-amortize that 30-year loan again. So your payment just gets cheaper and cheaper. And that total payment is so low for people's wages as they stayed in their homes longer and longer that unless you really had to move, there's really you are in such a good financial position. And that story has been here for years. I just don't want people to lose focus on the total cost of housing for a lot of these people. Because when you buy that house, your purchase price, your taxes are on that. Some states, your property taxes will rise faster than others, but your total housing cost is so low that if people can afford it, they tend to move, right? We see this in the data. Even new listings data this last week is not that far off from what we saw in 2021. Mortgage rates were 3% lower back then, but there's just not that death, divorce, employment a line that we see every single year. Well, there are natural sellers, but we've had this process of people staying in their homes longer well before COVID came. And then on top of everything, when you're dealing with inflation, boy, your house is that fortress. It is that financial fortress where everybody's complaining about, well, my rents went up, when everything went up, and you're sitting there living in your house for your 11th or 12th year, and you're like, wow, my cash flow is good. I don't want to give that up. And that I think is a valid premise, because what happened is we saw cash flow get better, right? Get noticeably better in an inflationary environment. Boy, your home is do you know how other countries would love to have a 30-year fix in America? Canada, Norway, Sweden, all these countries are tied to short-term debts. Their payments are going to go up on them regardless of where interest rates are, because they're tied to short-term debt. So all those countries, they're at such a risk, where here in America, we have the most loans under a 30-year fix in history, right? So we have that benefit here. And of course, 42% of homes don't even have a mortgage. So we are in a very good spot financially. And this is one of the reasons why the economic expansion in the previous cycle was long. COVID-19 recession was brief. And even now, with all the Fed rate hikes and all the banking drama, we still haven't broken the labor market, because household balance sheets look so much better now. You could see it in the data. And we do see some stress in some auto loans or something like that, but those are the subprime markets. They traditionally have higher credit risk. But in general, the American middle-class homeowner looks great, right? Because it's the same concept it always was. Fixed debt payments, wages rising, cash flow gets better.
Yeah, I love hearing that. It is interesting they say that there are certain areas, right? Because I have seen consumer debt creep up, you've seen savings decrease, but obviously you're saying that's just not the normal middle America. That's the renter group, or what's your thought
Well,
there?
here's the thing: is the savings rate percentage had decreased noticeably, but it's kind of a stock versus flow. We still have like $800 billion of excess savings in the system. So the savings rate percentage has been increasing the last few months, but there's so much excess cash still compared to the pre-COVID rate. So even though the savings rate has fallen, we still have 800 billion excess. That's in deposits, and a lot of people made a lot of money. Usually the savings rate is actually pushed by like events, like when Microsoft gave a special dividend, the savings rate kicked up because that money goes into people's deposits. When people sell their stocks for possible tax consequences, that boosts up the data. But here, even though the savings rate has fallen so much, we still have like $800 billion of excess money in the system in reserves. And again, homeowners, on paper, their FICO scores are great. FICO scores have been great since 2010. That's cash flow, right? So that class is doing really good. People like to mix renter financial profiles into homeowners, and that doesn't end well. So I think there's that aspect of nominal credit card debt or credit growth runs with economic expansions. So when people say credit growth is growing, yeah, that's how the economy expands. If credit deteriorates, that's a bad sign. So I think people make too much of the credit debt growing. That's how our economy has always grown, right? People borrow money, buy a car, buy a house. Credit card utilization rates aren't that high, really. So I think people are looking at the wrong indexes. I would be very bearish if credit growth declined. That would mean people aren't spending. That's traditionally what happens in a recession. That was what we saw that in COVID. Credit deteriorated and then came right back up. So credit growth itself is fine. It's a healthy function of the economy. It's the debt structures underneath them that are concerning if it's bad. Housing, we fixed. The 2005 bankruptcy reform laws fixed. Even these pay now or buy now, pay later, those are very small balances compared to the consumer balance sheet. So we've done a lot of things on the consumer side to keep things healthy. And that's part of the reason why the economy hasn't broken yet. The household balance sheets are still good. But eventually all cycles do end. So here for myself, I'm just really looking at jobless claims at this point. When that breaks, we fall into every traditional economic cycle post World War II. Jobless claims is usually the last thing, and it's rising, but it's from a very low place. So those are the things I'm focusing on at this point, because I do believe once that breaks, the 10-year yield should fall and mortgage rates should fall with it.
So what about new construction, like new builds? Any thoughts on how that factors in?
Very interesting. One of the most incorrect things I've saw on Twitter, which I always love to correct, is a lot of people said, well, there are more homes under construction than ever. Supply is coming. And I thought, oh my God, nobody has ever read a new home sales report for 15 years. So the builders do not operate in an environment where they push massive supply onto the marketplace. They have a data line called homes completed for sale. Do you know how many new homes are completed and ready for sale today in America?
Not many.
71,000. For a country of 330 million with a workforce of over 155 million, we have 71,000 new homes available for sale. But one thing I try to stress to people, even in the worst days of the housing bubble crash, that number never even got to 200,000. Inventory comes from the existing home sales market, because the existing home sales market is this massive stock of homes, right? So if people are living in their homes, their vacancy rates are low. Where are you getting that inventory? It's not from the builders, right? The builders are right now, we have more homes that are under construction that haven't even started yet compared to the homes available for sale. So it's like 96,000 versus 71. So you're not going to get millions of homes in that from that sector. But the existing home market, if you have a job loss recession and people have to, sell their homes, in that case, that's a better premise than the builders. The builders they don't flood the marketplace with supply. That goes against their entire business model. So don't look for them for help ever. This has been a big talking point of mine for the last 12 years. I've written many things about it. Their job is to make money. They're not the March of Dimes, right? They're not here to just to build and ruin their margins. And here now, the benefit the builders have is that they can, they don't like inventory picking up, because then everybody would want a discount. So they'll cut prices, they'll push mortgage rates lower, they'll do what they need to do to move product. And I think a lot of the bad takes last year was that people thought, okay, well, new home sales crashing, we're going to have millions of homes come on the market. Tell me that you've never read a new home sales report in the last 15 years. Yeah, because if you had, then you realize, the builders don't really do that. They just basically, they take a contract. It's like 16 months. Now, COVID-19 delayed everything to be built. And all of a sudden, when they're ready to give you the house, mortgage rates spiked on them. So now they're like, okay, let's slow things down. Let's make sure we find buyers. What do? Let's buy mortgage rates down and get these homes off. And this is why building permits have been falling for a year, but housing completions is still rising, right? The builders have a backlog of homes to work with, but it's completely manageable. It's not millions of homes. Another factor is what's good for shelter inflation is that we do have over 900,000 apartments under construction. So they'll eventually come along. The best way to always deal with inflation is supply, right? Because that supply is there forever, right? If you're trying to kill inflation by demand destruction, that's only a short-term fix. So the good thing for inflation long-term is that we do have over 900,000 apartments. Anything helps in that. We have over 144 million total housing units in America. So that supply that we're getting in context to the available units, put a little bit more perspective in that. But still, all these things are good in fighting inflation over the next 12 to 24 months. This is why I don't believe the 1970s inflation premise works at all here. Shelter inflation just took off like crazy twice. We're not going to have that kind of marketplace where rents take off again. So those are the positive things about the builders, is that they do have a lot of 5-unit constructions under the works, and more supply is good in defeating inflation.
Yeah, I think our loan officers feel like they're getting beat up because of just what you said, that the builders, because they've got, stock coming available, are offering financing incentives that they can't compete with. So I got to imagine that that's where, Deborah, where your question was coming from, right?
Yes.
Yes, it's a unique thing that the reason this is happening is because total active listings are at all-time lows. So I try to convince Wall Street of this for the last 6 months. Back in 2007, the builders had to compete with 4 million active listings in distressed sales. So their product, which is a more expensive product, right? A new home versus an existing home. So new homes are always more expensive, right? They've got all the bells and whistles if you do an apples to apples comparison. Now they're like, oh my God, there's still under 1 million active listings in America. We have an advantage here. We can push down rates, right, to move our products, because they have some margin capacity. They can lose some money on that. They are what I call efficient sellers. They sell homes as a commodity. An existing homeowner, that's a whole different ballgame, right? That's somebody that has to sell the house, make sure they find another property, win the bid on that property to get their family in. And here, the builders, they don't have to worry about that. Their job is just to boom, 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 get the right price, right mortgage rate, so they can move the product next, right? So it's a business, right? So they're very efficient, where an existing homeowner has all these different variables on, do I even, like, one of the things I saw when mortgage rates went from 3% to 6.25% back to 5%, there was so much rate volatility that sellers were like, whoa, what are we doing? Do I really want to even list my house here? But when mortgage rates went from 5 to 7.375 in a very short amount of time, sellers just said, that's it, no way. I'm not taking a chance of putting my house on the market and then have mortgage rates jump on me 2% within weeks, right? That's not going to work. So the bad part, our mortgage market kind of resembles like a third world country that has to deal with the dollar getting stronger and inflation and all these things, and their rates are really wild. So mortgage rate stability is to the benefit of every single American, including the Federal Reserve. So things calming down is good. And what we saw early in this year, we had one rate spike, and people pulled back from buying homes because nobody wanted to deal with that. But now that rates are just slowly kind of moving back and forth in that 6 to 6.75 range, that's somewhat manageable compared to what happened last year. Last year was a historic event. Like, literally, we had twice in 1 year where we had 3 to 2% moves within a year heading higher. not happened anytime in recent history. So we don't have that marketplace. Things are a little bit more calm. So when rates do fall, and if the Federal Reserve wants to stabilize the housing market and get that, kind of out of a recession mode, they have the tools to do that because you have people there that are ready to buy. That's what that first move lower in rates did. We saw the stabilization. And just remember, home sales are historically low right now. People that follow my work over the years, I say it's really rare in America after 1996 for existing home sales to trend below 4 million. It's only happened one time, really. That was in 2008. So here we are with over 155 million people working in the biggest demographic patch. So when rates fall, that'll help who? Younger home buyers, right? One of the sad data lines that, we got to see this last year, the baby boomers were buying more homes than millennials. We don't want that. I have this whole economic skit I've done for the last 8 years before 2020. I've always said housing is a year's 2020 to 2024 story because housing is very simple, right? People, they rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. You look at the demographics of housing, years 2020 to 2024. Oh boy, here we are. And guess what happened? Pregnancies tests took off in 2020, right? Birth rates are picking up again. So with our demographics, people getting married at 28, 29, having kids in 30s, there we are. Makes sense, not complicated. So we have people, younger people that want to get into homes. When rates fall down, that should help them out. We don't want baby boomers to actually, technically Gen X is the biggest percentage, but nobody cares about us because we're the middle kid. So the baby boomers are bigger and the millennials are bigger. So Gen X on a percentage basis, but they're smaller. So nobody cares about them. But we'd like to have more younger Americans buying homes, having kids, creating households. That's what a vibrant country does. We don't want people that look like the Federal Reserve members buying more homes. That's not positive for anyone.
Well, I think it's so interesting because the latest study was that when rates hit 5.5, everyone wants to buy. And you kind of already nailed it. When we started heading down towards lower rates, we saw applications pick up and housing, bidding wars, heat up again. So isn't that really the challenge by the time that the people who are waiting for 5.5 to come? I mean, they're going to be, yes, it'll be more affordable for them, but they're going to be competing in a super low inventory market with lots of people.
I'm always somewhat suspect of surveys with buyers and rates that like an X point. I just think when rates fall, the history of housing demand just naturally gets better. So people were buying when rates went from 7.37 to 7%, from 7% to 6.5%. The data line started to get better. Of course, when they go even lower, you're going to get more people that are there. It's more affordable. That's when you want to buy. What we saw last year is when rates went back from 6.25% to 5%, it stabilized the data, right? And then that freaked the Federal Reserve out. Like they were like, no, we cannot have people buying homes. We need to crash the housing market, and they were talking up the bond market, talking up rates and, saying that we have to do this. But we saw that in the data that we got stabilized at 5 to 5.5%. Nobody thought we would see the data get better when rates went from 7.37 down to 6.5, down to 6.25. That I think was the shocking thing. So we keep it simple. Rates fall, demand tends to get better when the 10-year yield goes up, right? Rates go up, housing demand gets worse. So this year to date, we have 9 positive purchase application data, all moving kind of when rates fall, and then 6 negative purchase application data prints. When the 10-year yield rises and rates rise, it gets worse. So definitely if we get to the low 5s, that changes the narrative even more. But we've already seen the stabilization in data and also a lot of seller credits for existing homes. People can buy down rates, even that, or 2-1 buy downs. There's other products available to help in this situation, and that's helped stabilize the demand. But to get like real growth, boy, if you could get to 5 or even below 5%, here we go. In that sense, you get the buyer pool gets bigger and bigger. And the thing is that the buyer pool getting bigger and bigger with total active listings near all-time lows. That's the problem. That was, I created the term the savagely unhealthy housing market in February 2022 because bidding percentages were increasing. We were headed to 75, 80% of the homes in America were at bidding wars. In 2022, the single family weekly listings got as low as 240,000. That means we had 240,000 homes available for sale in 2020. That was the bottom low. That's how bad the active listings data got. And the Federal Reserve was like, we got to break this, because home prices would have gone up another 20% in 2022 if rates stayed below 4%. So they didn't want that, because it was feeding into, they believe, cost through inflation, and they wanted to stop that. That's why housing was the sacrificial lamb for them early on. And it should be different for them when the recession hits. They're counting on housing getting the economy out.
Wow. Well, okay. So I have to ask, because I know we only have about 5 more minutes, but what is something that you wish people would ask you on these interviews? Because I know you do a ton of interviews. Is there anything like looking for icebergs or looking ahead, or stuff that's getting lost in the noise? Like what's something we didn't ask that you think should be discussed?
Do not fall for the vacant home grifting act in America. Our biggest professional trolling grifters in the United States of America are what I call anti-central bank people. These are people that were born after 1913 in America, and they hate everything because they hate the Federal Reserve. And when they hate the Federal Reserve, everything is bearish all the time. It's a grift. It's a tactic for them to get clicks. And one of the things they've used it's funny because I tweeted one out this morning. They say vacant homes, there's over 14 million vacant homes. Millions of homes could come onto the market and flood it. This goes to these are the people that said the silver tsunami was going to happen in 2015. Every baby boomer was going to list their house. They always have these tactics. Don't fall for the vacant homes have been falling actually since the peak in 2008. And even this year, it's still heading lower. Follow active listings. Active listings is all that matters. All these speculative theory about vacant homes coming to the market and millions of homes are going to blow out and home prices are going to fall 30, 40%. These are done by professional grifters who do not forecast, right? It's an act. They do not forecast with their name's face. One of the things I've done on Twitter, I'm sure Deborah has seen me do it. I challenge every man in America to a live debate. I want you to come on so your kids get to see you, your spouse get to see you, your coworkers. You're full of it because you don't forecast. They've gotten away with this because nobody in the academic world challenges them. Me, on the other hand, I take Bill the Butcher Gangs of New York gift and let's go. But we're going to get you on camera and then we're going to force you to forecast. So if people don't give you written forecasts, they're just trolling, right? And that's the housing discussion since 2012, right? I've dealt with the housing bubble boys for over 12 years. The forbearance crash bros, they're all the same people. One thing is common. They don't forecast on record. Get their names, get their face, and get their forecasts at least 5 to 10 years before you listen to anybody, because the rest is professional grifting for attention. That's not how economics is done since the Peloponnesian War. That's not how it should be done over the next 2,000 years. Get a forecast from them.
That's just like the loan officer who's going to quote a rate but not put it in writing, right? Everyone, we all know that. So, Logan, we already know we can follow you on Twitter. We know that we can subscribe to HousingWire Plus and we can see all your stuff there. Got your podcast. Like, where else can people find you who are all now intrigued and want to learn more?
If you have an Instagram page and you really want it to be nerd out, my Instagram stories are just all charts and all economic data all the time. So
lots of them.
Yes. So I literally try to go over everything on my story. So if you like that kind of stuff, okay, I'm your guy. And Instagram is the only other area. I don't have a Facebook account, but Twitter, Instagram, HousingWire Daily, which is a top 10 business podcast in America. I go on that show twice a week. We go over the weekly data as things that matter, but the HousingWire tracker is the new thing we created this year. And this is basically everything that I do on tracking economic models with housing, but we do it on a weekly basis because on a weekly basis, we get a heads up of what's going to happen in housing in the future, and perfectly timed because things changed on November 9th and December and January. And I do not remember anybody else talking about that, but a tracker, a proper economic model would have shown you that things were getting better.
And I know on Thursday mornings at 5:30 a.m. Pacific, I know exactly what you're sitting there watching. You're watching those jobless claims, and just super grateful for you here. Deborah, I'll let you close us out.
I'm so thankful that you took the hour to spend with us. I do encourage everyone to, I I choose Twitter, but I also choose Instagram because there's days I think there's 20 story posts, and you could learn so much and just take one of those charts that Logan shares and gives his expert narrative around. And that could be your own social media content. But make sure that you are, careful who you're learning from. Obviously, we trust Logan and appreciate everything that you guys are doing at HousingWire and really all the content that you put out there to help us be better at giving better advice so that it trickles down to the families who need good advice. We can give it and not just regurgitate, fake news or these bold headlines that are just meant to scare people and grab attention. Let's instead be more valuable and intentional. So guys, I can't, express enough. You guys need to be following Logan. I know John Downs, I saw him on here. He does a lot where he's been following you and was super excited to be able to hear you on this podcast. And so thank you, Logan.
My pleasure. And my pleasure. And I'm about to do a Logan chart nerd tour across the country. And I hope to see some of you guys in Texas, Arizona, New York, and other places. And we're going to nerd out big time.
Oh, can't wait. Can't wait. All right. We'll get you all that information. Thanks again, Logan. Thank you all for listening. We're super grateful for everyone. And we look forward to seeing you on the next episode of the Win Now podcast.